Moving on to today's proceedings, first session we have today is titled Value Education, My Experience by Vetri Subramaniam. This session would be moderated by Ravi Dharamshi. Ravi is founder and Chief Investment Officer at ValueQuest Investment Advisors Private Limited. He has been associated with Indian stock markets for over 21 years. After graduating, he worked his way up to stock market business, spending 4 years at Rare Enterprises, where he was involved with research, private equity deals, and value creation activities. Ravi has an MBA in finance from McCollum Business School, which is part of the Bentley University, USA. Ravi, over to you.
Thanks a lot, Deepak, for the generous introduction. Only thing that I really want to remain passionate about is to remain a lifelong student of investing. And I would like to thank CFA Society of India for keeping this desire to learn very much alive. The lineups for this year have been fantastic. Archives of these videos remain a treasure trove of knowledge and learning. And I'm looking forward to this session as well, which promises to be a super session. We'll go through the journey of value education of Mr. Vetri Subramaniam. Mr. Subramaniam is a stalwart of the industry with nearly 3 decades of experience in the industry. He has experience across industry spectrum in various capacities. I'm not going to give his resume over here, but I believe he is the best combination of experience as well as the hunger to keep learning. He's a very prolific learner. I have followed him for many years and have always found him to be articulate in his thought and very balanced in his approach. He never minces his words and is always open to sharing his learnings. So with that, I would like to hand over to Vetri sir to take us through his journey.
Thank you so much, Ravi. It's a delight to be here today with the CFA Society members. And I think you sort of set the stage very nicely by talking about lifelong learning, because that's what this journey is about. And I think it's quite unique. Certainly full credit to the CFA Society for thinking about how all of us as professionals can continue to learn and evolve over time, because every field is always evolving, and it's important for professionals in the field to keep up to date with progress. And my own education is by no means complete, and which is why today when I talk about value education, it's really something that I think is still a ongoing thing for me, and I hope it continues till the day I can stay mentally and physically active and just continue learning every day. That's really the delight, when something clicks into place and you feel that you've learned something new. So I'll try and share some of my thoughts today, both about my own evolution as an investor, as I've thought about the whole journey of investing, and also connected back eventually to something that I thought may be of interest to this audience, which is really thinking about it more in the context of the institutional perspective, because I think that's something which perhaps doesn't get understood very well. So I thought it'll be useful to sort of run you through the challenges that are there when you think about managing money in a institutional framework. So we'll talk about that, and I'll also share some of my personal anecdotes or journey as it's evolved for me. I hope it's visible on the screen now. So yeah, I'll just get yeah, perfect. So I'll just get going with that. So I really call this my journey of value education. And those of you, in fact, I suspect almost everybody who's on this conversation today, if you've been through the Indian education system, at some point in life, you've most probably had a class which was either called value education, or it may have been called moral science, or some such equivalent. And when I think about some of the things that I've come to believe in as an investor, I think the phrase value investor, some part the phrase value becomes redundant in that. But when I think about what I've learned as an investor, I could almost say that, this takes me back to where I was when I was a student in school, because these are some of the things that I actually learned in value education class all the way back in school, in college. And, if you read this laundry list of things that I've put over there, I'm not going to read them out. Uh, you know, put your hand on heart and tell me that these things have nothing to do with investing. In fact, I would warrant that each of these things have everything to do with investing. And to me, the two things which really stand out when you think about investing, and particularly when we think about that term value investing, is really the first one, which is, karam karo, phal ki chinta mat karo. And, these points that I've sort of, put up on this slide is a combination of thoughts. Something is from the Gita, something is from the Bible. I've gone to a Hindu school, I've been to a Christian convent, and some of them are also from the Tirkural, which is, sort of a document written in Tamil Nadu, which became very famous when former finance minister P. Chidambaram used to very often quote from that, and something that, I encountered when I was in school in Chennai. But each of these statements are actually something that I think would really be a Gita or a Bible for an investor. So I didn't quite appreciate it in school when Mrs. Hema took value education classes, or when Father Jose took value education and moral science classes in college. But today, when I look back, each of these things actually has great applicability. I also think the last point on that list is very, very important. When these good teachers took me through these points, I couldn't fully understand or appreciate what it was all about. Because that last point, nothing ever becomes real till it is experienced, is equally true. Right. So, and I think this has great relationship to investing, which is that you can read all the books, all the Gitas, all the Bibles, but till you actually do it yourself, till you experience it, until you stumble, until you actually sit back and reminiscence and think about it, you will never realize, and you will never, come to terms with this, because only when it is experienced does it become real. So yes, I did go through value education class, but maybe I discovered the value of what they were telling me only about 20 or 30 years later. Moving on from that, I think many of you would be familiar with this very famous psychology test, which was conducted somewhere in the early 1970s, I think at the University of Stanford. And it was called the marshmallow test. It was a very simple principle that the creators of that experiment were looking to do. And they basically said, you can either get an instant reward, or if you're willing to delay your gratification and you're willing to be patient, you can get a much larger reward. And the way they tested this principle of delayed gratification is that they brought in a bunch of kids and they offered them, in that context, a marshmallow. And they said, here's a marshmallow, you can choose to eat it now, or if you're willing to leave the marshmallow in the plate in front of you for 15 minutes, at the end of that, we'll give you 2 marshmallows. Now, the kids went through a whole range of emotions, as you can see in this, sort of visual that's been created about that, because they were left alone in the room with the marshmallow for 15 minutes, right? And it was really a test of them versus temptation. And really, it was a test of these two things. Can you delay gratification when there is potentially a much larger reward somewhere down the road? And can you be patient? Now, very interestingly, when they conducted this test, the reason for doing that was really to understand behavioral trends. And what they discovered was when those children who were able to delay gratification, remain patient, and wait for the 15 minutes when they would then be given 2 marshmallows instead of the 1 marshmallow at the outset, these could be connected back to better SAT scores. Many years later, when these little kids actually went out and wrote their SAT exams, this could be connected back to better BMI scores, basically sort of better fitness scores. This could also be connected back to better educational attainment. Now, there have been various variations and repudiations of this, but I still think it's a very powerful test of your ability to delay gratification and also to be patient. The only thing that I have not seen so far is whether anybody has actually compared the outcome of this test to see those who were able to delay gratification, did they actually have better performing 401k portfolios or not? Maybe if they could, somebody did a study of that, that would then really connect the dots back to what I believe is the key to being a value investor, which is really this, right? To be a value investor, I think you have to be able to pass that marshmallow test. Very often it requires you to stand apart from the crowd, use the word contrarian if you choose to, and patience is a must. Why do I say this? Because very often in the conversations, it's all about value investing and growth investing, and people thinking of these as two very, different sort of pillars. East is east and west is west, and the twain shall never meet. But I don't see it like that at all, and I'll tell you why later. To me, the opposite of value investing is not growth investing. It's actually what is popularly, and there's enough academic evidence on this as well. The opposite of value investing is actually momentum investing. Why? Because it promises instant gratification. You're buying the stocks which are performing, and very often the data does show that they continue to perform. There's enough academic evidence of that. But that's the difference between the two. Those who want the instant gratification of price confirming their beliefs, and those who are willing to be patient because they are in the long game, those who are willing to be lonely, willing to be contrarian, because they realize that's the way eventually they can create much greater returns for themselves of investors. So this is where really I connect back the whole idea of value education, the marshmallow test, the delayed gratification. And what I'll try to do over the next few slides is really take you to this idea of value investing and growth investing, though we think of these as two different pillars, have a lot in common. Really, what is different from value investing is that concept of momentum and always getting gratification from price. Going back again now to something that my dear professor Vaidyanathan, way back in my investments class in my MBA, so this must have been sometime in the winter of 1991, and during our class, he actually talked about the concept and the theory of investment value, which is actually something that was enunciated by John Burr Williams, and this is where he enunciated it. Now, today we all take the concept that is mentioned here for granted, but this was something which was very, very radical when John Burr Williams in the early 1920s actually propounded this, right? So today we take the idea of intrinsic value for granted. We know that it means a discounting of the cash flows, but it was very radical when John Burr Williams actually pronounced this at that point of time. And the reason I say this, and what I mentioned earlier, that eventually you have to experience it and only then it becomes real, is that even though this was something that was in the classrooms explained to me, when I actually started investing in 1994 in a professional role, it was very easy to get caught up with all the noise, right? I mean, you had these reports, you got the opportunities to meet managements. These were, of course, the early days. It was still harder to source information than it is today, but you get caught up with all that noise. And actually, this whole concept of, intrinsic value and understanding it was something that I think I actually forgot for a few years. And it's only after about 4 or 5 years as I stumbled through things and I started looking for anchors and I found a few mentors who guided me, did I sort of, eventually come back to this idea of eventually it's about intrinsic value. It's not about the noise factors to which we otherwise end up paying so much attention. Very quickly, and I won't spend time on this because I think this is a sophisticated audience. When we talk about intrinsic value, when we talk about value investing, we are not talking cheap valuations. I think what passes off for cheap valuations and cigar butt investing is not really the way I think about value investing. But again, I won't dwell on that too much because I'll take that as something that this audience already sort of understands the intricacies and the nuances of that. One of the statements which really puts in context what I have come to believe about value investing is that it is not really a choice between value and growth as two sort of opposite ends of the spectrum. It's really about thinking through what is it that we do in investing which can create greater value for us tomorrow compared to the value today, right? So that's the way I really like to think about investing, that we want to buy into those businesses which might have a higher and superior value tomorrow. So therefore, in that sense, the whole concept of buying $100 bill for $50 and then waiting for it to unlock to $100 value later is slightly less than satisfying, because the value of the $100 bill doesn't really go up over time. And really what we want is to be able to benefit not just from the sort of vagaries of the mood of Mr. Market, but equally we want to be able to benefit from the intrinsic growth and value of the businesses that we are invested in. So I think this comes from Howard Marks, who anybody would say is an outstanding investor. And I think his summation of this is something that really, appeals to me, that it's not about value and growth. It's really about the value today and value tomorrow. What's the bridge between this, and how do we sort of get better outcomes in terms of what the value tomorrow might be? So what really lies this bridge between value today and how does value tomorrow potentially be much, much higher? Now, here I'm going to sort of go back a little bit and perhaps put it in a framework, put it in the sense of some of the books you might have had, some of the famous investors you've heard of. And I'm sort of extra simplifying it here. There's a lot more nuances to investing, but really you could sort of break it down into what I call two approaches, right? One is what I call the owner approach, which is really about the fundamentals of the business, right? And this is something which was really sort of, I think, brought to center stage by Phil Fisher, best known for saying that the best time to sell a business is never. But this was based on his unique experiences, right? And when he talked about business fundamentals, he really brought a owner perspective to it. I think the perspective he brought to it is forget the stock market. Why does anybody have a business? Why does anybody invest in a business if there was no stock market? You do it for a superior product. You do it because there is a significant growth opportunity. You want the top class management to be able to execute fantastic. And I think one of the defining things that he brought into the framework, I've captured it here as companies that have the ability to fund their own growth. But he was one of the first people on Wall Street, when you go back in time, who really sort of questioned this concept of companies needing to pay dividends, because he made a very simple sort of change in thought process, which is to say that if the company has a significant growth opportunity, it has the resources which it can deploy at a superior return on invested capital, you are actually better off deploying that cash flows to grow the business rather than being forced into paying dividends to shareholders. That's the way he constructed it. But the way I prefer to think about it is really that what it really defines is the ability of a business to fund its own growth. Now, many of you, maybe you come from business families, maybe you have somebody who's a small entrepreneur in their own right. They're not always thinking about listing a company and selling a company. They're thinking about running it. And when they're thinking about running it, what really drives them is this: the return on invested capital and the ability of the business to fund its own growth over time. That's what creates the value of the enterprise for them. And that's why I call it the owner approach. It's almost ignores the existence of the stock market. Now, the other sort of approach, which I'm sure all of us are aware of, and I'd say really Ben Graham, sort of is responsible for the origins of security analysis and the rise of investing as a profession. Gave us the concept of the intelligent investor. Now, the reason he gave it is that he brings in the concept of the stock market to investing and says that here's this character called Mr. Market who is prone to, moods of extreme pessimism and extreme optimism. The future is full of surprises. Mean reversion, which is, I believe, one of the most least understood forces of capitalism, is also a reality. Agency risk is a significant issue that you're dealing with when you're investing in the stock market, because you're not really the owner, you're not fully in control of the decisions that are taken by the management and the founders running the company, and therefore the concept of margin of safety to benefit from the moods of Mr. Market. So I think many people focus on the differences between these two schools. I prefer to focus on what is common between these two schools. And to my mind, those who endlessly debate the differences between these two schools, it says more about them and their personal choices than it does about the similarities of what both these gentlemen brought to the table. I wouldn't point to any one individual as, necessarily the only fountainhead of knowledge. I think I've already quoted a fair number of people to you, and I've learned from all of them and their experiences in real time as I've stumbled through it. And if I think about my way of sort of approaching the investing business or the investing challenge, this is what over time I have come to distill it down to, which is that it's really my opportunity set, my way of investing is to think about the opportunity set as a barbell, right? So yes, there's a large universe of companies. Maybe it looks more like a circle, but within that circle, I think of it as a barbell within which I can bring two different approaches to work. One is what I call the owner approach, which is more sort of, the Phil Fisher inspired thought process. And the other is to benefit from the mood swings of Mr. Market, which is the intelligent investor, which is to recognize that, there are mean reversion opportunities in the market. There are times when, businesses trade at very attractive valuations because something is being underestimated, because Mr. Market has, manic moods. And how is it that we can try to benefit by buying a business significantly cheaper because of those moods of Mr. Market, and then try to benefit from mean reversion, both in the business cycle as well as in the valuation cycle. But there are some exceptional businesses, and these are kinks in the mean reversion cycle, which are really those businesses which have sustainable competitive advantages, they have growth opportunities. They may never get classically cheap in a way that we look at some metrics, but I do believe, and I'll talk about this later, there are methods in which we can sort of test these companies as well for being able to buy them with a degree of margin of safety. And really, to me, margin of safety is something that can be applied across both approaches. You just need different metrics and tools to do it. And the commonality between both approaches is to buy what is underestimated in one sense of the term or the other. So very quickly, moving on, I'll just run through a little bit of how I explain each of these approaches. The owner approach, and I'm not going to sort of spell each of these out in great detail. I think most of this is well known to you. I also heard a little bit of Pat Dorsey yesterday, and I think when he talked about moats and the evolutions, a lot of this actually entered that conversation. So it's about companies with steady and consistent growth trajectories, simply because very often they have a long runway of growth, as the term has become popular today. They have pricing power, very often the function of that moat. They tend to have much lower margin volatility. They are able to self-fund their growth. And I've typically found over time that these factors go together. Companies that have low or no debt, they tend to self-fund their own growth. The most important criterion for me in this is actually the point about return on capital. Not just consistently above cost of capital, but very often significantly above cost of capital. And these businesses, right, because remember when I talked about the owner approach, it's an approach which almost ignores the existence of the stock market, which remember is eventually a market for capital. It's a market in which entrepreneurs can access capital, but these entrepreneurs don't need it because they're able to self-fund their growth. Their businesses generate enough cash flow. In fact, most cases, they're generating enough cash flows to fund their own growth. And they're therefore redeploying capital into the business at a significantly superior return on invested capital, much higher than cost of capital. And when you think about what we call the magic of compounding, this is really the simple source of that equation. To my mind, the owner approach is a little bit like, growing a plant, except this is a plant which requires only a little bit of water to get started. And after that, the plant, just taking in what's available in the environment is able to fund its own growth without ever coming back to the shareholders and making significant demands for capital. The one thing that I would say about the owner approach, and I'll talk a little bit about this later, is that it's not about blue sky outcomes, right? So it's not about presuming that the company can grow to the moon, or it will, be that once in a blue moon sort of opportunity. It's really about testing what the business has already demonstrated. So really, when we talk about the owner approach, everything that I put on this slide is something that we'd already like to see in that company and its business model. Now, how do we bring margin of safety into this equation? And I'll talk back to some of the examples from history. One of the ways you can bring margin of safety into the equation when you're thinking about the owner approach, because sometimes it classically challenges you in terms of a few valuation metrics. But the way we've done this is to think about it, one, in terms of the size of the market. This is not something which, I would say was intuitively something that I knew 25 years ago. But one of the classic examples of this, I would say, over the last 25 years, all of you are very familiar with HDFC Bank and how, that's been a bank which has, and all the private sector banks, which over time, we went from a situation where there was only a public sector banking universe. Now, you didn't have to bet on the growth of the banking sector. You just had to bet that a bunch of these private sector banks over time would be able to take market share and grow faster, not just because the sector would grow, but also because they could take market share. So you didn't have to make dramatic assumptions about the growth of the market. All you had to size was the size of the market opportunity and the ability of a particular management or a business model to be able to gain market share within that. Another way that we think we are able to bring margin of safety into play in many of these owner approach investing cases is to think about the implied growth as sort of indicated by the valuations of the company vis-a-vis the delivered growth that that company has demonstrated. And this is why I said it's more about the past data. Obviously, what happens in the future will drive our returns. But over time, when I've seen the last 15 years, we've seen more than one opportunity come about in businesses where we've had an opportunity to buy into steady growth, compounding businesses at a point in time where the implied growth in the stock price was significantly lower than the growth they had delivered over the past decade, where the free cash flow ratios that these companies were generating in the current point of time was significantly superior than what they had already sort of demonstrated over the previous period. So in a way, the embedded expectations in the stock price was significantly lower than what they had done in the past. And to my mind, that was one way in which we could get margin of safety into the equation. Now, the third and fourth point that you see there, which is the scope for margin expansion and base rates, I'd say these go together, because what I've experienced over many years in India is that sometimes when a nascent business gets going, its margin structure perhaps looks very different when you do the hard work of going around the world, looking at other similar business models, understanding why their margin structures look very different. Very often, it's simply a function of scale. It could also be a function of the fact that that industry has not yet reached a particular tipping point in India. So when you then start to think about margin of safety, a lot of that margin of safety can come for you simply because that business model is yet to reach the point of evolution that it has elsewhere. And then when you go and look for comparisons in the universe outside, we've seen this, for example, in the fast food business. We've seen this in the consumer durable business. If you looked around the rest of the world at these opportunities sometime in the last 10, 15 years, and you sort of use that as the framework to understand where these companies over a period of time could move to in terms of their margins, it actually gave you a significant, in my opinion, margin of safety in sort of buying these businesses. So again, this is another way in which you can actually bring the margin of safety into play, even in the owner approach. And I'll talk about the next point later in more detail. But I think one of the things that I've sort of evolved over a period of time was really come to understand the importance of return on invested capital. Because, when I came to the market in 1994, these were the early days when, most of the conversations were about penetration. And the typical research was about the penetration of this product in India is X, the penetration in Asia is Y, which is significantly higher, and the penetration in the developed world is Z. And therefore, there's this great opportunity, and many of us got carried away with that. But really what made the difference in terms of those companies which could bridge the value between the value today and the value they've created, 20 years on, is the return on invested capital. And there is a kink in the pattern of return of invested capital, which is to say it is a lot more persistent than the forces of mean reversion. Now, this is true that it shows up in few industries a lot more than it does in other industries. But I think this has been, one of the important things in my journey of learning, which is to really emphasize return on invested capital a lot more than our ability to understand growth in the near to, medium term. So I think of growth increasingly more as a variable in the ROIC outcome rather than as the most important variable in the entire equation. Finally, it's, as I mentioned again, it's not about the blue sky scenarios. It's about companies, and we've done this quite successfully, in my team at UTI and before, where actually we've continuously screened the universe for companies that have demonstrated this track record of high ROIC, low margin volatility, great capital structure, ability to fund their growth. And we've found the persistence of these models to continue doing what they did in the past to be very, very high. And I believe that has significant implications for investing. And I'll show you how we've used this in the next two slides. This is actually a McKinsey study going back all the way to the early 2000s, which is when I first came across it. And they looked at this data over two time periods, which is what was the ROIC of the company going back to 1994 on a 3-year basis. And for the same data set of companies, fast forward 9 years to 2003, what was their return on invested capital 9 years later? And I think the striking thing in this data set that I saw then, and it really sort of influenced me over a period of time, was that row going down the middle, or rather the diagonal going down the middle, which is those bright blue sort of bars, right? Because those demonstrate the persistency of outcomes over long periods of time. So if you look at the companies which had an ROIC greater than 20% in 1994 on a 3-year average basis, fast forward to 2003, and 50% of the companies continue to be 20% ROIC businesses. Similarly, you move to the left extreme, 43% of the businesses that had ROICs of less than 5%, 9 years later in 2003 on a 3-year average basis, still generating ROICs of less than 5%. So yes, a lot that happens in investing is a function of what happens in the future. But I think what the data set taught me was that there is persistency in ROIC outcomes. Yes, it is industry related. Those of you who look at this study will see that they actually broke it down also by industries, and certain industries tends to demonstrate this more than others. Here at UTI, the fund that I work with as CIO, we've done some similar data analysis of the data sets in India over almost 20 years. And I'm just showing you one snapshot of the data here that you see on this slide. And I'll just explain this to you. We have an internal rating system in which companies get rated as R1, R2, and R3. These numbers essentially reflect at the end of FY15, looking back at the previous 5 years ROC, companies that have an average ROC of greater than 18% categorized as R1 companies, companies that are between 10 and 18 rated as R2, and companies that are less than 10% as of FY15, looking back over the previous 5 years, categorized as R3, right? Then we fast forward 5 years hence to FY20. What does the data set tell us? Out of the 151 companies that had that ROCE of above 18% in FY15, 114 remained R1 rated companies 5 years later. And when I say 5 years later, it's not just the FY20 outcome, it's the 5-year average outcome as of FY20. So what the data actually tells you is that the ROCE pattern again is very, very consistent. There is a high degree of persistency in the data. And we've done this over 20 years, and we see this pattern consistently show up over every rolling period of 5 years and 5 years that we've looked at. So when you look at those arrows from top to bottom, remember that over the 5-year period, companies can migrate. So a company could be R1 at the start period. It could migrate to R1, R2, or R3 5 years later. But look at those bars. The majority of the time, the company ends up in the same box in which it started. So 75% of the time, the R1 rated companies remain R1. 58% of the time, R2 companies remain R2. And then again, R3 companies tend to remain R3 companies, which means weak ROCs, and they tend to remain weak ROCs 5 years later. Maybe it's the cyclicality of the business, maybe it's the management, it's a combination, but persistency is something which is clearly visible. Now, this has two implications from an investing perspective. You have to pay heed to the fact that these numbers are very, very persistent. Yes, when you get it right, like look at the circle all the way to the right extreme of that chart, R3 rated companies, right? So these are companies which had a return on capital less than 18%, less than 10% on a 5-year average basis in FY15. 4 of these companies migrated to a R1 rating 5 years later. If you get it right, there's a very low probability, only 10% migrated. But if you get it right, obviously the returns are phenomenal. On a simple point-to-point basis, those 4 companies out of 33 generated an average return of 383%. So in a way, in a nutshell, this is about the probability of migration vis-a-vis the returns that are to be had. The probability of migration is actually low in terms of going from low to high or high to low. Companies tend to stay at the same level of ROC. It's a function of various things. But even if the company stays at the same level of returns, actually, with a high probability, particularly in that R1 bucket, the returns are actually quite attractive. And that sits at the heart of the owner approach. However, if you're willing to take the probability combined with a slightly superior potential for return, then you can soup up the returns. And I think a large part of what the intelligent investor approach to investing does is sort of buy into the idea that there is this cyclicality, there is this mean reversion, try to pick up those opportunities and try to benefit from it. So to my mind, this chart once again encompasses both approaches to investing, and it's really a personal choice about how you choose to put them together to try and create the portfolios that you wish to. For me, it's always been, and it's evolved over time to be a combination of these two approaches. Very quickly on the intelligent investor approach, and the way that I've tended to use this is really to compare where does ROC currently fit in relative to history. So when I talked about the rating system that we use on the previous slide, one of the things that gives us insights into this is to look at, okay, here's a company which over time, because of its cyclicality, is typically only an R2 rated company, because its 5-year average is typically only somewhere in that, maybe 13-14% range. It's somewhere between 10 and 18%. But what we see in the data set is that there are a few years, individual years, where its ROC actually punches way above its typical trajectory to even a 30% or a 40% level. And there are years in which the ROC falls to single digit or maybe even goes into losses. These are the classic cyclical businesses, right? So there are 2-3 things that we look for in these. Where are margins relative to history? Secondly, has the industry moved to an environment where profitability is so weak that there is going to be a supply side shakeout? In fact, over years, the conclusion that I've really come to is that when you're looking at cyclical businesses and the typical commodity business, The most important factor is not understanding where will demand come from, but really to look at the supply side. Because when the supply side shakeout happens is when you actually get the best opportunity to invest in a superior company, hopefully with a slightly better balance sheet, or at least a balance sheet that can tolerate risk, and you get the entire benefit of a cyclical outcome. But you don't do this blind. You look at the past data to understand where is ROC relative to history. That gives you the margin of safety. You look at where is, what is the degree of risk in the balance sheet in terms of debt. And this is a very interesting thing. I've always said that we are very happy taking P&L risk, right, which is depressed profitability for the company, but we don't want to take too much balance sheet risk in the businesses in which we invest. But equally, what I've seen over time in my own experience is that in cyclical companies and commodity companies, you do want to have some debt in the capital structure. Because when you have debt in the capital structure and the company goes through a positive cycle, it actually adds a tremendous kicker into your returns. So it's really about taking intelligent risk. You don't want to completely avoid that risk. You want some risk. And if you just look back to a recent example over, I would say, the past 1 year, in the Indian context, we have many metal companies. There are some metal companies which are leveraged with a lot of debt on their balance sheet. And there are some metal companies which have no leverage on their balance sheet. They're sort of net cash, right? And you look at their stock price performance over the last 1 year, that is a story in itself. If you buy the companies which have the leverage in their capital structure, the returns are far superior to what you get in a commodity and cyclical rally as compared to the companies that are net cash. So it's trying to get an optimal balance, because if the recovery is delayed, you don't want to be in a company which has the risk of being shut down. And that's where all those factors kick in. What's the potential for a supply side shakeout? Is the company you're investing likely to be among the last men standing because they are the lowest cost operator in the business in which they operate? Now, when all these dots start to connect up, then you've got an opportunity to invest in a mean reversion opportunity, despite the businesses experiencing challenges, valuation on your side, and a potentially great upside as that ROC mean reverts. So this, to my mind, is really the heart of the whole intelligent investor approach, using the manic modes of Mr. Market. I won't spend too much time on this, but I think this is well known. The pitfalls to mean reversion, too much debt in the capital structure could prove to be terminal. Misalignment between management and minority shareholders. Again, this is a potential pitfall in mean reversion. Changing regulatory norms or societal norms results in increased costs for companies in terms of doing businesses. It could be pollution control norms, it could be other societal norms, and these impose higher costs on businesses which cannot necessarily be passed on to customers. So these again become pitfalls in the mean reversion journey. Certain businesses have limited or no terminal value, and we could argue that that's really the case with a lot of the businesses, particularly in the fossil fuel space. Yes, there will be periods where there could be money-making opportunities in them as well. But from an intrinsic value perspective, you need to be aware of that risk of disruption and decay. And therefore, these are some of the pitfalls you need to be aware of when you think about mean reversion opportunities. Just a single slide on sell discipline. I would just put two simple points here. This is, a topic in its own right, and, it requires a whole separate session to discuss this. But really, my thumb rule for the stocks that I owned in the portfolio, where I've held them more from the ownership approach, is don't stress the valuations too much. Very often these companies keep surprising you for a variety of reasons. The ability for their moats to sustain for longer, the value that they can create from adjacencies. So you do consider the alternatives, but really your cell discipline is driven by when fundamentals deteriorate. One of the strategies that we run at our fund house, not trying to talk shop, but it really follows this approach very, very systematically. We do risk manage through position sizing and portfolio attributes, but some of those strategies then run with portfolio turnover ratios annualized of less than, let's say at least in the region of 8 to 12%, and we've demonstrated this over nearly a decade in some of these strategies. So that cell discipline of in the owner approach and strategies which are fully dominated by the owner approach. Portfolio turnover is an outcome, but you can test how good they are in terms of the longevity of their willingness to own businesses by seeing what their portfolio turnover ratio is. And this is something that we keep track of in strategies that emphasize the owner approach. I think when it comes to the intelligent investor side of the portfolio, where you're looking for those mean reversion opportunities, it's typically about being a lot more concerned with where you are in the business cycle and in the valuation cycle. So you tend to be a little bit more on the trigger as compared to the opportunity set that lies in the owner approach. Sometimes, and very, very rarely, I've actually seen businesses transition, right? Something which started out in the intelligent investor bucket because it was cheap, but for a variety of reasons, but mind you, it was in the right sector, it actually transitions to the other side of my barbell and actually becomes something that you can own in the owner approach. So you tend to wait on those, but very difficult, because, we've seen this in quite a few cases. It's very hard to really sort of come to terms with the fact that, in those businesses, the metrics change so dramatically. At some point, you tend to get nervous because remember, you started off with a mean reversion opportunity, and then you're waiting for mean reversion to kick in the opposite way. But rarely and once in a while, there will be these wait opportunities. But in the mutual fund context, to my mind, a lot of our cell discipline, and that's the reason I put it here, is really a function of monitoring our position sizing. We can't allow the risk to become extreme, and I'll talk about that later. And equally, it's about the portfolio attributes and how we make sure that the portfolio is well diversified and well managed or well characterized on various attributes at all points of time. What the barbell does for me, and I think this is most important in every investing approach, you need to be able to sleep well at night. Don't ever choose an investing strategy which doesn't allow you to sleep well at night. For me, what the barbell does is really allow me to sleep well. And that's why, I'm pretty happy with the way that approach shapes for me. But I completely recognize that there are other approaches. I'm not fundamental about it. I'm not ideological about it. I think each person can bring a different toolkit to the approach, and eventually the test of what works is obviously, does it work? B, can you sleep well at night while practicing it? Quickly moving on a little bit on the learnings and challenges, and maybe Ravi and I can circle back to some of these for more detail later. But I think one of the biggest things which differentiates what we do in the institutional context is the fact that we are running open-ended schemes, right? And in the open-ended schemes, the underlying principle is the three investor principle. There's a pool of assets. It has to be appropriately marked to market at all points of time. There are three investors: the investor buying into the fund, the investor who remains in the fund, and the investor who chooses to exit the fund. In an open-ended scheme, and we have funds which go back 20 years and 35 years, there could be an investor who's exiting my scheme today because he started his journey 30 years ago, and today his needs have changed. There could be somebody coming into the fund today who's now looking for a 30-year journey going ahead. The fund has to be appropriate for all investors at the same point of time. It's not just about the appropriate pricing and liquidity within the fund, but that's why we have risk management frameworks. I'll give you a simple example of this that I've personally seen. A very famous fund manager used to run an offshore fund for India way back in the early 90s. And I remember his portfolio had a 10% position in Infosys. And he had to continuously keep paring down the position because risk control doesn't allow you in the mutual fund industry in most cases to go beyond 10%. It was a $120 million fund. He ran it quite well. The fund never scaled up beyond the time, and then he sort of left the fund when it was about 550 or 600 million. Maybe the peak was 800 million. And I remember when he left the fund, we did the math. And if he had held on to his Infosys position, which was 10% of his portfolio sometime in 94 or 95, the value of that single position was in excess of $1 billion when he left the fund. And he still had about 9% of Infosys in his fund, but the size of the fund was only about 550 or $600 million, right? So it's a classic case of what might work in investing. If he was an individual investor, I don't know, he may have done things differently. But in the mutual fund industry, you can't allow a single position to become so dominant. So I think this is something that you always need to keep in mind in the mutual fund context. There is a risk management framework to ensure parity, both in terms of today's portfolio liquidity and temporal parity between investors who come into the funds for different needs at every point of time. Another big challenge in the mutual fund industry is being true to mandate, right? So we talk a lot about this, true to mandate, sticking to the style. The challenge with this is that every style goes through periods when its style doesn't match the mood of the market or the season. The biggest challenge you face at that point of time is managing the stakeholders. How do you ring fence the team? How do you ring fence the fund manager? Everybody from your board to the people reviewing the fund in the press, the gatekeepers at your distributors are, bearing down on you because the strategy is not working. So this is something which is easier said than done in the mutual fund industry, where, we publish a daily report card, we get evaluated all the time. And this is one of the challenges. And I think the good institutions are those that have created the ecosystem in which they can ring fence. Maybe fund houses like ours, where we've done a diversity of strategies to give us that ability to demonstrate competence at every point of time. But this is very, very important in an institutional perspective. How do you remain true to mandate while managing your stakeholders at all points of time? Investment process, again, very important in the institutional perspective. What I say as CIO is that I have only 3 variables in my control: the investment process, the people, and the culture of the team. Performance is an outcome. And therefore, when I think about the team as a whole, the only thing we manage is the investment process. We can't actually manage the outcome. When people are giving money to us for 20 years and 30 years, continuity becomes very, very important. We don't know if the fund manager in question will stay with us 20 years or 30 years. But if the operating system remains consistent, then it gives us the ability to stay consistent over time, and therefore it gives the investors continuity. So today, when we tell investors, think about investing with us for 20 years and 30 years, we need to have a process which delivers that continuity to them, or otherwise there is a mismatch between what we are asking them to do and the way we are managing our team. And obviously, you need a data set to monitor discipline and consistency in investment process. We can talk about the team later, but I mentioned this, very important. You want a diverse team. You need to manage the talent, and the culture becomes very, very important in this team-based approach to investing. It needs to be about discussion, debate, and collaboration. My role as CIO, as I often say, is to allow the debate to take place, to debate it till the cows come home, because the more questions we ask ourselves as a team, the more likely it is that when the market poses us a question, we've already thought about it and we are able to deal with it. So managing that team in an institutional perspective, I think, becomes very important. Equally important in this context, I'll just jump here to the report card, which is, how do you evaluate fund managers, right, in the institutional context? Are you going to evaluate them on a daily basis? That won't work. Do you evaluate them quarterly, annually? Now, we typically do it over a 1 year, 3 year, 5 year period, with more and more of the weightage going towards longer term. Because if you don't do that, how will you ensure that you're asking your fund manager to think long term? You're asking your investors in the scheme to think long term. Secondly, how do you measure vis-a-vis benchmark? How do you measure with a peer group? These are all very important things, right? Because as it's been said, the way you design a compensation and evaluation system, that is what drives the thought process of the person. So these become very, very important in the mutual fund perspective. Strangely enough, I don't find enough gatekeepers asking us these basic hygiene questions. How do you evaluate your fund manager? Over what period do you evaluate? So they evaluate our funds over a particular period, but they don't think about the question. I won't say this, I won't generalize it. There are some who do, but you really need to understand how is it that we evaluate our fund managers if you want them to think long term. One of the other challenges in the investing industry, I would say, is the behavior gap, which is to say our NAV returns and fund manager performances are very different sometimes from the experienced return of the investors. Why does this happen? Unfortunately, very often they come in when that particular style is doing the best, and they tend to leave disappointed when the style is doing the worst. And I think the onus is on us as fund management companies to educate investors, to handhold them, to tell them beforehand that there will be difficult times for a strategy. It's what you do during those difficult times which actually determines your outcome. Finally, I think the biggest force in our industry at this point of time is the rise of passive, for a very simple reason. From a cost perspective, it's value for money. There's certainty of outcome because you know that you'll be benchmark plus or minus tracking error, which is a very small number. And how do you know ex ante which fund to select and which fund will generate the alpha? So this is really the biggest challenge for us in the institutional management space. Of course, many of us, including my own firm, we now offer all solutions, active and passive. It's the choice of the investor. But as active investors, this is something which is increasingly becoming a very big challenge for us. So this is sort of some of the key perspectives I wanted to highlight on the institutional side. Finally, a little bit of connecting it back to my own personal experience. As I said, it's all about your personal journey. For me, when I started in the June of 1994 to April 2003, those of you with gray hair in this room would remember, but just to be specific, from June 94 to April 2003, the market went down point to point 23% over a 9-year period. But what I learned during this period was really the distinction between owning a company and becoming too top-down in terms of trying to ally all my thoughts to what the market would do. During this period, the market did terribly, but if you backed the right companies, there was tremendous money to be made, and many investors made that, particularly in the IT, consumer, and pharma space, which provided great compounding opportunities during this 9-year period when markets went nowhere. So to my mind, this is the period where I really started to think about the stock market as a market of stocks rather than blindly sort of coming with a top-down perspective that maybe I was guilty of when I started my career. It was a long, cold winter. One of the things I've also learned, and I've seen this over time, is that during difficult periods, divergences accentuate both in the business cycle, metrics of companies, and valuations. That's just the way it is. And you need to be careful about fighting that divergence too early. The boom years, 2003, 2007, if there's one thing I would point you to, is that the best cycles start when valuations are cheap. The difficulty about this part of the cycle was that the narrative, this came much later. I would say really this was by maybe the latter part of 2006, 2007. The focus was entirely on the narrative, very or limited focus on cash flows. And really what I saw during that good time was the opposite of what I had seen earlier, which is convergence. There was convergence in business metrics, there was convergence in valuations. And again, that's equally something you need to be careful about, because if you overstay this convergence trade during good times, it actually hurts you. It was also a time where really, I think for the first time going back in 2007, where the whole concept of free cash flow sort of began to become more powerful in my mind because of a conversation I had with a mentor where we were discussing the launch of Kindle in 2007. And my immediate response was another cash guzzling product. And my mentor pointed me to the fact that look at the last time Amazon raised cash and then think about the way to interpret this business. And that's when I looked back and realized that the last fundraising by this company was, I think all the way back in the early 2000s. And actually, even though they had accounting red profit, they had actually started generating large amounts of free cash flow. So I'd say, my own evolution in the owner approach and the power of free cash was really something, that stemmed from this conversation about the Kindle launch in 2007. And I'd say, therefore, again, there's a lot of personal stuff which comes into the investing space. Finally, again, as I say, investing is personal. I went into the dot-com period as part of a startup. Unfortunately, the crisis, the meltdown in the market meant that the business took a turn for the worse. It couldn't have happened at a worse point in time for me personally, because, the market came down 70, 80%. Prior to that, the portfolio was up some 500%. But not only did the market come down, but that was exactly the point of time where, I was out of a job. And therefore, my risk appetite had actually come down pretty much to zero. I talked about this in length in a column I wrote for Mint last year in April, during the peak of, the last crisis. And I said, this is how it sometimes happens, that the worst point in the crisis, your own personal situation is so painful that you don't have the risk appetite to be able to take the benefit of it. So this is something you need to keep in mind when you think about investing, that how will you sort of prepare for those difficult times, because mind you, it will become personal at that point of time. The GFC, on the other hand, to me, proved the fact that in every crisis, there is an opportunity. Because when the GFC came along, again, I was part of a new asset management company, but we hadn't started business. And when the crisis broke out, it became an opportunity for us, because we actually got to buy another asset management company. And I use the word buy, but we pretty much actually got paid to take over the company, because in that crisis situation, they were desperate for a buyer. So I use this framework of investing being personal because I've seen both sides. Losing my own job in 2001, post the meltdown, not having any risk appetite to invest. And on the other hand, when we had the ability, not me, but as an organization, to invest, we were actually able to use the GFC as a springboard to be able to grow business. So, I think this quote by Edward Thorp pretty much sums it up. You're shaped by your experiences, but you need to learn from this. And this is something that I wrote about in that column last year. It's worked out well. I wrote the column in April 20 that this could well be an opportunity. But I don't say it worked out well because of the outcome. I say it worked out well because the framework and the process said it was an opportunity to be used. The fact that it worked out, so spectacularly well is not something I knew. It's not something that was ever guaranteed, but which is why, you need to be able to think about how you will be able to play when the opportunity comes along. So, that brings me to the end of a very long chat. I hope I haven't overshot too much. These are just some of the, final tips I wanted to, leave on the screen for you. But yeah, we can pause here and, open it up, Ravi, to any questions that you have.
Thank you so much, Vetri sir. That was fantastic. Just when you think that you've read all there is to know about investing, and then something new comes along. And I really appreciate your the way you have put across this approach of intelligent investor versus the investor approach. I think many of us on a daily basis struggle with this thing. I mean, if I were to take an example, you can very obviously see an opportunity in some of the state-owned banks, but it doesn't fit. You get married to the approach that you've been taking, and it becomes very difficult to answer yourself, why would you be wanting to buy something like that when this is how I deal with it. So the ability to hold to constant approach in your mind and practice them on a successful basis is tremendous. I really appreciate that. Thank you so much for that. I have few questions of my own, and I will ask them before we take some questions from the audience as well. So this defining yourself as an investor or evolution of your investor, even Warren has gone through the evolution of being from Grahamian to adopting the Phil Fisher approach a little bit more. How do you do that? The evolution of business seems to be way faster than the investor seems to be evolving. So, first we need somebody like you to put it in a framework, in a theory that we can understand, and then we adopt that approach. But the businesses seem to be, evolving way faster than that. How do you catch up with that?
That's always tricky. But I'll just give you, two insights into this. I think sometimes we emphasize too much being early or being first to the party. And I say this shamelessly. All decisions are eventually, they've been mine. But very often, I've been very happy to let others take the risk early on, bide my time to, sort of build confidence about, what the prospects of those companies are, how they are evolving. And I don't think I've ever seen that as being a delay. The only switch you need to flip in your mind is the switch of being to buy at a higher price, potentially even at a higher valuation than perhaps the first time you actually heard or saw that business. But you do it because now it fits into the framework, or the data set is backing the decision that you wish to take. In 1994, one of the stupidest decisions I took, Ravi, was, I remember in my prop book at that point of time, we owned HDFC. I think we got some shares of HDFC Bank, as it was sort of a allotment you got if you were a shareholder in HDFC. And I think within a few months, we just sort of sold it. I think it took me about 3 or 4 years to figure out how stupid a decision that was. But having realized that it was, I think since 1998, if there is one stock that has sat in most of my portfolios across different roles, different firms, and been a significant contributor to alpha over time, it's been that one stock. So never get caught in this thing of, if I didn't see it first, I will never buy it. Be prepared to wait for the data set to come to you, which gives you the conviction, and act on it at that point of time. If it's truly a phenomenal business, you don't have to worry about being late to the party. But the second part, Ravi, which is I think equally critical, is you must have a framework, right? You need to have a framework in terms of being clear about which are those data points that you will emphasize, and then continuously keep an open mind in terms of evolution. It's not that everything that I'm talking to you today is something that I knew 25 years ago. Some of this has been a process of evolution. As you stumbled, you keep improving the data set. But the most important thing, I would say, people have talked about this, keep a diary, virtual or physical, keep writing down, and write. Actually, there's no better way to learn than writing down. And that process of writing down and putting those frameworks actually always helps improve your decision process. It doesn't mean that you're becoming a quantitative investor. It just means that you're putting down and articulating your goalposts and your sort of variables and frameworks in writing. I think that just helps you take decisions. It helps you deal with new business models. It helps you deal with everything that the market throws your way.
Right. No, yeah, that's a fantastic take on it. Just a little bit addition to what I meant earlier was you keep learning and evolving, but yet the feeling that you keep getting is you're distancing yourself from the basics of fundamental investing. The businesses nowadays, like you mentioned, the dividend model, some of the biggest wealth creators, whether it is Microsoft, Amazon, or a Reliance closer home, do not pay dividend. And the kind of M&A and the kind of capital they invest in innovation, it becomes very difficult to judge whether the capital allocation is right, wrong, whether return on capital invested will stay. How do we, ensure that we are still sticking to the basics of fundamentals of investing?
So that's a good question, and I'll answer this more in the context of my experience, and my experience is not as an individual investor, because I've been in the professional field, and therefore, for both compliance as well as ensuring lack of conflict, I've tended to focus my investing on the portfolios that we run. And I think in the institutional context, in a way, this decision is sort of taken partly out of your hands. Partly you also do it consciously because of what I said, the 3 investor principle, maintaining temporal parity of the portfolio. So you've got to remain diversified. You've got to position size your portfolio appropriately, individual positions, certain risk templates, your exposure in terms of your top 10 exposures, concentration. Now, for example, one of the things that could be the outcome of the owner approach is a significant level of concentration within your portfolio, which then also creates risk. So I think in the mutual fund portfolio, honestly, I would say, Ravi, it's not something which causes me too much strain. And I say this with all respect, simply because we've always thought of it in terms of position sizing and managing risk at a portfolio aggregate level. And because I've always tended to be a little bit more balanced, people could either argue that I don't have a fixed view, or people could argue that I've learned to balance two extremes and still function rationally without becoming schizophrenic. But I think it's that balance of approach which allows me to sort of balance both risks, right? I'm equally happy having some risk in my portfolio in cyclical companies with debt sitting in their capital structure, and equally backing companies which are, about those attributes that you mentioned, so much investment in the intellectual stuff in the balance sheet, the moat, so on and so forth. But keeping that balance allows me to sleep well at night. So I would say it's a question of keeping balance and keeping that diversification. Just one additional point there, Ravi, and I'll agree to this. Concentration of portfolio is a great way to create extreme wealth. But when running diversified portfolios, it doesn't necessarily work. Point number two, concentration is great because we only look at the success stories. The concentrations which led to extremely negative outcomes very often don't enter the conversation set. So to my mind, if you practice diversification, risk sizing, position sizing, these risks can be handled. But don't think of it from the point of view of maximizing. Think of it from the point of view of survival. If you can survive as an investor for 30 years, believe me, your returns will be outstanding. The trick is surviving 30 years.
Right. Yeah. One more concept that you touched upon was applying margin of safety to the investor approach. But when these new age businesses, the way they are coming about, and the average life of a unicorn is, before they become unicorn is 7 years, and you don't have enough history to judge them by, whether it is the marketplace that is evolving or the traditional metrics don't apply at all. So how do you apply that margin of safety framework to a new age business with very limited history?
No, so that's a great question, Ravi, and I would say we are still sort of evolving our answer to that question. The easy cop-out answer for me is to say, again, position sizing, but I think that's a less than satisfactory answer. The way we've done it is, I would say, twofold, right? One is to start with, look, is this a large enough opportunity? Second, is this a company which has or operating in an industry where we have a sense that the worst part of the capital burn stage is behind us, right? I think the thing that I as an investor would have trouble with is giving money to companies where they are still burning money, literally at a negative contribution margin. If it is a question of spending money because the business has not reached the scale at which it can start to generate, positive cash flows for reinvestment and for superior return on capital, I'm still okay with it. So it's sort of a filtration process at this point of time. Is the company still in? How large is the opportunity? Second question, has the industry reached a sort of structure in which capital burn is now less likely? Industry level. At a company level, is the contribution margin sort of reached that point where it's at least gone positive? Based on my size of the industry, how far am I from the point in time where operating cash flows and free cash flows can also turn positive? If we get through these 5, sort of goalposts, we've been willing to take the decision in terms of investing in some of them. So the easy part was the cop-out answer, which is position sizing. But I would say these are the sort of 5 goalposts we've sort of set for ourselves, and broadly remaining slightly choosy. So we've done a few of these, but I'd still like to believe we've been a lot more choosy than others. And, maybe just my perspective and my, I would say, less than satisfactory track record as an IPO investor. I've seen others in my team or others in the industry do it better. I consider myself to be a lousy IPO investor. So I've been very happy in most cases to sit out IPOs and say, let the company report data for 2-3 years. That's when I will get to know them. And that's when I'll take an investment call on them. Right now, if at all, I think I like the business and the model. I'll keep my feet wet, because keeping a 25-30 basis point in my position keeps me engaged with the company, but I have time to figure out a really big investment decision in this company later. And that's been my approach in most IPOs. I really don't like the fact that all I have is 3 years of data. I don't like the fact that all I get is 30 minutes with the management. And believe me, right now during the IPO season, IPOs are so hot, we are having to pitch to the company for the first 5 minutes why they should consider us as an investor, which leaves me with about 25 minutes to get to the heart of the company. So yeah, it's a very difficult decision, and I'm happy to sit out many of them.
Right. There are many questions that have come on the chat window, but I have still a couple of more questions from my end, and I have selfish interest in understanding how you deal with it. So one of the thing is macro versus micro and managing time. So we are supposed to be, when I say we, I'm talking about the fund managers, supposed to be efficient and smart allocators of capital. But capital keeps coming, but the one real limited resource that we have is time. There are only 24 hours in a day. How do you maximize or efficiently utilize your time without compromising on the learning machine that you are? And in today's day and age, there is so much of noise on the macro front or from every front, even from the on the micro front. Every quarter, besides the quarterly results, also now companies come out with an update, and there is, if somebody CFO sneezes somewhere, is also reported. So how do you manage? The two questions are intertwined. One is too much noise, and two is how you manage your time.
Oh, great question, Ravi. When I started my career in '94, the difference was that you had to go hunting for information. Actually, you were not receiving enough information. And I don't just mean information, even, good data inputs, you were just not finding enough of it. Today in my career, what I've seen is that the role has changed, almost 180 degrees. It's more about shutting out the noise and trying to ensure that you stay focused on the key sort of data points. What I would also say, Ravi, is my own experience over time. What I've increasingly seen, and again, it's from that whole habit of going back, looking at the data, looking at my own track record as a fund manager, analyzing the data. More and more, what I have seen, not just for myself, but even for other good investors with a good track record, is that really the difference in our alpha, presuming that we've created the alpha, has actually come from stock picking. So I would say in my own journey of evolution over time, I've continuously downplayed the impact of macro in my decision making on portfolios. I still love the macro part of it, but I've consciously reduced the impact of macro in the decision making and portfolio, because every time I go back and look at my own portfolio outcomes over longer periods, I've seen that the difference in my alpha has come from backing managements, backing individual companies, and the stock selection alpha, right? So when we look at our past returns, we can break it up. It's mathematical, but you can break it up to see how much was stock selection, how much was sector. You can also sort of break it up across, different macro parameters. We look at how much came from, the thing that I talked about earlier, how much of my alpha framed from companies where I could successfully catch their movement from being an R2 or an R3 rated company to an R1 rated company. So all of this data we can analyze. And the one thing that I've learned is that more of my own alpha has come from the stock picking, not from my top-down macro. So honestly, Ravi, I've just dialed it down. I continue to stay engaged, but my interest in macro now is more to sort of counter most macro things that I hear, rather than start to use them in my portfolio. I've become a lot more, I would say, driven by bottom-up portfolio considerations. And the one thing that I always tell my entire team is that every now and then, please make your portfolio ab initio. Just presume you don't have your current portfolio. Make a portfolio that you would want to construct today if I gave you a new job, and then connect it back to the existing portfolio. That's a far better way to incorporate any top-down thoughts into your portfolio, rather than trying to change the portfolio for a particular top-down thought process.
Great, fantastic. Well, one more follow-up to that is, how do you have a fantastic framework of measuring the returns and the source of those returns that you have generated, but how do you measure or improve, and that you are learning, or that your team is learning, or you as an organization collectively is learning? How do you measure and how do you improve upon the learning aspect?
So I'm going to answer this more in the context of the fact that, I've been for a variety of reasons in sort of a leadership role for many years, going back to, the early 2000s. My trick, Ravi, in terms of learning is point number one: always hire people who are smarter than you. The smarter the people you surround yourself with, the more likely it is that you will learn. The more likely it is that you will also open your mind to new ideas. The second thing that I look for when I look for my, not just the people I hire, but sort of my circle of contacts and mentors. I prefer to have in that circle people whose thought process is radically different from mine, right? Because if you don't surround yourself with people whose thought processes are varied, not necessarily radically different, again, you are not exposing yourself to the stimuli which causes you to rethink. So honestly, to my mind, that's the only way, Ravi. You surround yourself with a circle of people in your team, outside your team, reach out to them regularly, talk to them, not because you want somebody to confirm why the stock I own is not doing well. I know you also own it. We both feel similarly, but talk to the people who have different views. That's the only way to keep that learning in place. And having young people in the team, Ravi, I would tell you, is completely invaluable. So I always tell my team members, right, I value experience, but I love the insight that the younger people in my team bring, because they haven't been shaped by the experiences I have gone through. They have not also imbibed the skepticism and unfortunately the cynicism that has sort of crept into me over the years. So I think all of these are most important. The other great way to do this, Ravi, is books, right? Because books also open a window of the world into things that are not immediately within your circle. So I would say these are the two ways to measure it. I mean, two ways to do it, but I don't have a way to measure it. I mean, I can't answer that part.
No issues. Coming to one aspect of the approach that you mentioned, in an intelligent investor approach, the sell decision is quite, you enter with the framework that there is going to be a sell decision at some point.
Correct.
There is a business cycle and a valuation cycle. And when you feel they are extreme is when you exit. But in an investor approach, you obviously valuation is not at something that you will look at to exit. So identifying sell in an investor approach becomes a big challenge. How do you do that?
I think that's really the trickiest one, Ravi. And again, when I look at those attribution numbers, when I look at my portfolio, and it doesn't show up immediately in the portfolio, but we can extract it and look at the opportunity losses, right? So to speak, the errors of omission. I find more errors of omission in the owner approach as compared to the intelligent investor approach. I think it's just sort of a reality that don't try to over optimize the equation. In the sense, don't try to perfect it. There will be some that you will make. I think the sort of thought process that I've had, and it goes back to that one point that I made, Ravi. Too much of the focus in modern day analysis, comes down to, has the company beaten expectations, not beaten expectations? It's about the margins, this quarter were worse, less. I think if you keep and continuously anchor to ROIC and free cash flow, to my mind, those two parameters have helped you hold on to good businesses during difficult times of their business cycle and valuation cycle. Because I find many of those concerns typically are growth related. They are very often external environment related, which are not in the control of the entrepreneur. Right? So I've typically found if you anchor back to free cash flow and ROIC, they typically give you slightly better decision making in that ownership segment. So when I talk about deterioration, I don't talk about deterioration of growth. It's really the deterioration of ROIC or free cash flow which should raise the red flag for companies in that bucket, not the quarterly earnings and not, okay, last few years growth has decelerated. maybe it's decelerated, not within the control of the company, but has ROIC sort of stayed intact? If that has, and remember that persistence data, that actually tends to be a lot more persistence than growth. So think about growth as an input into ROIC rather than a completely independent factor.
No, that is definitely one of my biggest takeaway. Persistency of ROIC over a longer period of time. Growth is a variable in the ROIC outcome.
Exactly.
I've noted it down. So yeah. So we'll take some questions in the chat. We have last few minutes left. So how do you assess?
Ravi, before you go there, I think somebody on Twitter asked me a very interesting question, which he said, what is something that you believe in which is very different from perhaps what others do? And with all due respect, I'm going to say that one of the things which people like us value the most, or at least many do, I have actually over time found to be less useful than what people interpret it to be, which is management meetings. Right now, I did tell you, Ravi, that management meetings are required, but I think the buy side and fund managers make too much about meeting managements. I mean, honestly, meeting management 4 times a year tells you nothing. And I think the whole concept of being on the buy side and getting preferential access to management is highly, highly overrated. In my, I would say, actually, the last 10 years, I have greatly reduced my meeting or engagements with management. I like to meet them once in a while, but I actually find it counterproductive to meet them beyond a point, because in a way, remember, there is a delicate dance happening in every management meeting. The entrepreneur is passionate, but he's doing a sales job of his side of the equation, right? So I actually find sometimes just reading a pure transcript of a management meeting is far superior than sort of necessarily showing up in front of management and, you know, meeting them every quarter. So if I were to say one thing I believe is slightly overrated on the buy side, it is access to management and management meetings. Honestly, we could all do a much better job of investing if we reduced the extent of interaction we had with managements.
Absolutely brilliant point. We are all as a herd running towards management and lapping up everything that they have to say, while not really critically examining what exactly are the actions that they are taking. So yeah, completely take your point. Yeah, coming to the questions that are in the chat window. So how do you assess management quality in businesses which are undergoing technological change? How do you assess if the old management with their endowment bias can be trusted to change course as things change? I'll say, for example, auto sector.
So there's no fail-safe methodology for this. And I think, therefore, you have to always presume that some percentage of your investment decisions are going to go wrong. If your investment process is that nothing can go wrong, then I think ab initio you have a problem, and that will freeze you in terms of your decision making. The minute you realize that some of your decisions are going to go wrong, you're setting a bar over which you will be able to sort of deal with better. You will be able to sleep better at night. So that's my, I would say honestly, my initial starting point. The second point is, again, I would say just go back and look at history, right? I mean, look at what this company over time has demonstrated. To me, nothing speaks louder than the demonstrated track record of that company in terms of dealing with change. You could look at how it has dealt with technological changes. Even in the auto sector, we've seen how technological changes have taken place. It's not completely new. Maybe this is one of the biggest disruptions, but they've taken place in the past as well, whether it was, four-wheeler, two-stroke to four-stroke engines, petrol engines, diesel engines, SUVs. So a lot of this is there. The second thing is, as I said, the metrics of that business, right? I mean, how often is that they tend to have that superior ROIC? How often do they tend to have, the ability to generate cash flows? If some of that data is in place, I am willing to back management. I'm very happy to be unambiguous about this. I don't expect that every management will always disclose and place all his cards on the table. It's comparative information. They would not do it. So I think somewhere you just have to say, okay, once I've got that margin of safety, I've got the comfort that the past data tells me to back this company, I'm happy to go out and take the risk. I could be wrong, but I can live with that wrong decision in the context of a 50 stock portfolio or even a 30, 35 stock portfolio that I run. Maybe this is a trickier decision for I heard a little bit of Pat Dorsey yesterday. 12 stock portfolio, yeah, the bar is pretty high. So maybe there you want to be a lot more careful about saying these are areas where I would choose not to invest at all. But in my 50 stock approach, and that's sort of my anchor number, I'm happy to take some of those decisions. As I said, those are the two metrics that I would look at.
Right. We have just a couple of minutes left, and I have this one interesting question. And you also referred to yesterday's Pat Dorsey's talk. So yesterday, Pat Dorsey in presentation, he said that my favorite holding period is not forever. It's the one during which I can earn an excess return. Keeping this in context, how do you find the equilibrium between the two weights in your barbell approach? One weight perhaps advocates higher turnover, and in other, it makes sense to hold for a really long term. Also, how do you do it looking into the windshield while only the rear view mirror shows the true results in due course?
True. So honestly, I've just tried to keep it balanced, and I won't say that is mathematical. It swings around, based on the market environment, it could go from 50-50 to 60-40 one way or 60-40 the other. But roughly, I've always tried to keep it balanced. The portfolio turnover is an outcome. So if I look within my own team, somebody who's very biased towards the owner approach, as I said, is closer to a 10% portfolio turnover ratio. Mine might go closer to 25-30. Again, observed data outcome, not a starting point number that I begin with. But I'm comfortable with that. So I'm not trying to necessarily optimize. To my mind, what the barbell pushes me to do is really think harder about, does the company fit here? What I'm not interested is companies that lie in the middle. Because to me, if you lie in the middle, you are neither here nor there. My portfolio is balanced, but the portfolio is balanced because the two extreme sort of sets of the barbell, right? That's where the weight is, right? That's why the barbell is balanced. The barbell is not balanced because weight is in the middle. It's balanced because the two sides are equal. So that's the way I've, tried to balance it. But I won't say it's a, mathematical optimization on that front. It's really just a thing of what I'm comfortable with. And secondly, as I said, I sleep well at night. And to my mind, the two unappreciated factors of success in being a good investor, one, sleeping well at night, and secondly, getting a morning boost of all the good hormones and endorphins by exercise. I know that I'm a lousy decision maker when I haven't got these two.
Right. Thank you so much for those nuggets of wisdom. And if I were to summarize, basically you have to make investing an act of wisdom rather than trying to be very knowledgeable and highly intelligent about all your decisions. Thank you so much. I'll hand over back to Deepak.